Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. When the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, somebody let Amber Heard in. I'm not. I think we should sit down and figure out what's going on here first before we get too deep into it, huh? Let's see here. So the move occurred at about 6:11. So let's say about 15 minutes ago. The only headline I see here on Financial Juice is Qatar to supply Germany with liquid natural gas. That's the main stuff. German CPI. Earlier than that, I don't know. Let's see here. Morning running diary. How are you doing? Welcome back. I'm gonna come in here. Maybe there was an economic number from Europe that I missed. No, that can't be it. Bank of England's FX rate is an important ingredient for UK inflation. Well, the thing is it looks like that the treasury market moved and the equity market moved. The dollar is moving to the upside, but it's not super strong. Didn't see the British pound really moving. It looks like it is probably a European headline. There was German preliminary CPI. Up 10% versus 10.4% expected. Let's see here. Month over month. Negative 0.5 estimate, negative 0.2, previous 0.9. Was it just the German CPI number? German inflation eases, boosting calls for slower ECB rate hikes. But if that was the case, why would the treasury market be? Why would rates be increasing? That can't be it either. Is it that? Is that it? I don't know. Okay, let's come over to the charts and kind of. Okay, so we are rolling over the micros here today, I guess. Although it looks to me like the volume is still in the back contract. I don't think that you actually. Well, my platform wanted to update them all today, but I don't think you switch until. I mean, you could trade it till tomorrow, right? Especially with Powell speaking tomorrow. Anyways, back to the charts. So we are retracing the up move that we had yesterday. I would say in the end it was a decent. Well, we had an up move overnight rather. I would say it was it was kind of tight action yesterday, but there was still some movement. I would say it was still okay. ES, a little bit of a downer of a day on the equity indexes yesterday. And oil responding in kind, but recovering those losses overnight. Gold and silver also kind of following the rest of the market, but largely within the range. Kappa also having a big down day yesterday and completely recovering it today. And we've got the dollar higher than it was yesterday. Dollar seeing like a huge, like that was a really big downturn and then huge reversal throughout the rest of the day. And that also resulted in a bit of a turnaround in Bitcoin as well, recovering the 1600 level. So that's basically where we're at. For some reason, I feel like my monitor is off. I'm gonna move that just a tad. Okay. Why? This is interesting. Something definitely happened. Something definitely happened. What was it? I don't know, guys. Canadian GDP? Well, we did have Canadian GDP, but the strong move down in the treasury market was before that news. It started as around, I would say, 8:15 Eastern time. Did you hate the morning overview due to the long introduction? We could shorten it, yeah. I actually was kind of thinking, it is a little long. Not only that, but like, the part of the point of the intro was to give people an idea of like what it is that they're gonna get from the stream, and I don't know if it actually does a good job at that. You know what I mean? I did helped a little bit there by making a video that went through my like workspace, but I have to think about how I can shorten it up. It's about like what, 30 seconds? Anyways. Part of the thing though, Zach, is that when I come in, like for that first 5 minutes, there's usually only one or two of you. I think part of it is because YouTube doesn't do a very good job at making it so that you can get into streams right at the very beginning. They don't anticipate that people would get in the stream at the very beginning. So for you guys, that's why I have like in the video description, I have like the permanent live stream URL, because you can bookmark that, and that's the easiest way to make sure that you get in, right? But anyways, I'll think about it. It could be something we do over the break. I'd have to think like how can I improve that intro to be more, to give people a better idea of what the stream is about, Needs to talk about how markets are not informationally efficient and that sort of thing. Treasuries did extend there a little bit. They did push into new lows, if only briefly. Scott Adams says censorship is the new voting. Same thing in oil. I'm like, we did have a move in oil. I would say that the move in oil was like much more limited. I mean, within the ranges and everything, but I do wonder if the only thing that I really saw at the time, the only headline I see here Going back is Qatar to supply Germany with liquid natural gas as EU seeks secure energy options. I'm not sure I understand why that would affect the treasuries though. So like, oh, there's a Davis Schools Twitter account. My school district is going to be starting school late today because it did snow. You know what? There were, in years past, this amount of snow would be no big deal. I specifically remember one day in particular for university where it was way worse than this and I still trudged through, and like most students didn't come, but I went, and the professors still did significant stuff, and it was really frustrating that I had to endure through all that. You know what though, this makes me think about though, bigger. I don't know. Am I already gonna like segue into like more political stuff? Twitter, man, this whole fight over Twitter is so interesting to me. Some people are just really, really upset about Twitter, and I'm sitting here like, Twitter is the best it's ever been. I feel like that, you know, I saw somebody the other day saying, you know, that, you know, he was saying that Twitter has become infrastructure, that governments use Twitter to get information out, and it's the best way to get that kind of information out because it's pure text. And I'm like, you know what? That's totally 100% right. But then they said, yeah, but then they're turning it into like extremist content and things like that. But, you know, that it's some sort of absolutist version of free speech, which number one is not true. Elon Musk has banned people for inciting violence, for instance. In fact, from what I can see, Elon Musk believes that they should continue to uphold the platform standards just fairly, that they weren't enforced fairly is what I think Elon Musk believes. And I feel that that kind of fairness is necessary in order for Twitter to fulfill that infrastructure role, because how can it fulfill that role if you don't believe that everybody's getting a fair shake on the platform? So it's really curious to me, because some people on the left are like, they all left before anything even happened, and it's just weird to me because everything that I do on Twitter, it's still there. Okay, so the treasuries are extending here. I really wish I knew what was going on. They are going short though, for sure. I'm a little worried though. Like, you know, this has happened a couple of times lately, and it did kind of happen yesterday, where it's like there's an initial bit of selling and then somebody comes in and buys it all the way back up. You know, we've definitely seen that one. UK says will allow banks to take more risks to stay competitive, says Reuters. Britain will change its rulebook to allow banks to take more risks in order to keep the City of London a leading global financial center. Okay. Are we seeing something where European bonds are bid? There's got to be a headline out there, and maybe I already read it and I just don't understand the implication. Can you tell how? Okay, Euro bonds are doing the same thing. There's not any spread change in them. Tell you what, if you get the Euro data, you should absolutely have my spread indicator out there and do spreads of some sort. or I mean, watched the spreads of some sort. Okay, so Zach asked a question. What is the process you went through to get into Goldman Sachs? Man, interviewing for Goldman Sachs was such an ordeal because they want you to interview on site with 3 different people per group. And I had 2 groups that were interested in me. Ultimately, it was the equities technology that wanted me. But oh man, it was rough. And they were totally into the sort of like ask a tough tech question. Like I think that one of the questions I was asked was that I needed that we needed to build a house. We needed to build a house, and you had to ask questions to determine what the requirements would be for building the house, and how you would build it in the aggressive time frame that was needed and everything. And it turned out that it was a house for elephants if you asked the right questions. Stuff like that. So it was rough. And they ask you more serious. The other group asked me more serious data problem solving type questions. Something about like finding some strange measurement on a triangle. It was difficult, but yeah, it was like that. Ultimately, though, for me, because it was in Salt Lake City and they were recruiting pretty aggressively in Salt Lake City, and I had a very strong interest in existing knowledge of financial markets, that among a tech person was highly valued, and that's ultimately what got me in there. I'm pretty ADHD. Like at the end of the day, I don't know, maybe I've just been thinking about that. It's not like something has happened or held me back lately from me being ADHD, but it's really frustrating. If you're ADHD, the world just constantly reminds you about it, okay? Because you find yourself doing things that are ADHD literally freaking every day, And yeah, being ADHD worked against me there. I wish that I had been gotten to the point that I am now, where I'm on a really good medication regimen and have everything figured out well much earlier, because I basically didn't figure that stuff out until basically I was on the way out at Goldman. But there's a part of the culture there that is extremely competitive. And when I say extremely competitive, I mean like these are the people that you've got to go to a private school and work super super hard and get into the top school and everything so that you can go and work do whatever it is at Goldman. And there's definitely a thing where if you have a rich parents and that sort of a thing, you're much you're probably going to hold a position in the company that is a better position than the other peons, and they work you hard. I felt that working there and staying employed there, because the reality is, like, the thing is, you think about it and it's like, well, okay, he didn't stay there forever. That's kind of a knock against him. But it actually turns out, so I worked there out of school, right? And of my 2010 technology class, all of the people that started with me, and man, when I was there, I saw that as an opportunity to like build my networking skills. I don't know if I was very good at it, but I did everything I could to try and remember everybody and remember everybody's names. I met so many people, okay? But I outlasted like 85% of them, 80-90% of them. Moved roles before I did. Pretty crazy, if you think about it. Yep, it was a rough job. Job that I work now is much less stressful. I have I have a work colleague that is really smart. Maybe he's a little ADHD like me, and he stresses himself out about the job way too much. It's like this job is easy, man. You don't have to be stressed out if you don't want to be. Are good with the fixed protocol? I mean, kind of. Like, the fixed protocol is pretty simple, right? It's just a stream of text that's delimited differently to be really, really terse is the way that I would put it. I didn't work with the fixed protocol. So you want to know more about what I did? The thing that I worked on the most there was testing the trading systems. So there was one group that we worked closely with that their job was to like write, if a new exchange was opening up, they would have to write the interface that would translate that exchange with our other systems, right? So they were the ones that they would be working directly with Fix and C# and that sort of a thing, right? It was a tough job, I gotta tell you. That one, the people that did that job, because you had to be, I mean, first of all, it was C# and performance was a significant factor. Okay, just noting here, we did move a little bit lower. We came back. There was a big offer at 04.5. It looks like they have filled that offer. They were not able to hold a bid at 04.5. So far, Treasury's not giving us any reprieve. Micro yields not moving too much. We've only moved about 5 ticks here so far, but overall on the session, it's about, they did move overall. So anyways, so these guys that worked on the fix on the I forget what they called them, the connectors, providers, or whatever the deal is. They because it was C# and performance was such a big deal. You know, it required like a real engineer to do it, right? But the nature of what you were doing was so tedious and rote. You know, it's like the same, basically the same thing over and over again, right? Get this to work with the new exchange, right? Rough thing to work on. I think eventually they moved that, they had a really hard time keeping those developers in Salt Lake. So eventually they moved that back to New York. They moved a lot of stuff back to New York. Well, in fact, I'm concerned for my friends that are still there. I know a couple of the people that I was working with when I left Salt Lake are still there. Some of them have actually moved up the chain a lot because well, my boss is the Mark Sharrock. He's the boss of Wells. He's the chief technology officer of Wells Fargo now, right? So he had moved up the chain, and all of the guys that were underneath of him that were doing a really good job became managers and that sort of a thing after I left. But they were working on Marcus. So now that Goldman is killing that, I don't know what happens with them. That's probably not a good thing for Salt Lake, but I do think that the company still valued that location and thought it added to it. So I'm sure they find something for the people. But that's kind of what would happen sometimes is, like for me, a big part of why I ended up leaving was just because the projects that I was doing were kind of done, or they didn't necessarily have a place for me. So if you have to let somebody go, you're the one that's least needed. And from their perspective, and it's the correct perspective, to be frank with you, from their perspective, it's like, well, it's really not that awful of a thing to let somebody go from Goldman Sachs. Like the honest truth is that almost everybody that leaves Goldman Sachs ends up going and making more money somewhere else anyways. So You know what I mean? Sup with the dollar? So, I don't know, man. I'm a little behind on that, aren't I? Because over the last 5 minutes, it's just like jumped like crazy. ECB warns of losses as it pays price for a decade of money printing, reports Reuters. Bitcoin getting creamed. Basically, this what this is starting to turn into. It started with the treasuries, okay? Definitely started with the treasuries. We're not sure why the treasuries moved. Now it's coming in with the dollar, and now because of the dollar, everything else is moving. The treasuries have not actually moved all that much since this move started to come through in the dollar. Bitcoin to 3,300, I wish. How much do you think it works against me to be hyper anti Bitcoin now? I'm not quite sure how I got to this point, to be honest with you. I mean, I was always skeptical of cryptocurrencies. Like here's the reality of like my journey in cryptocurrencies was like, it came out and I remember the first post on Reddit about it. And man, that was a really long thread. And I wish that Reddit was better at being able to search your posts, because I would like to go back and see what I said about it in the beginning, because I think I had it nailed what it was going to be like from the beginning. There was definitely things about trading that I didn't understand yet. If I understand what I knew about trading now, maybe I could have made big money from Bitcoin early on, right? But at the same time, if I had gotten involved in the cryptocurrency space, I don't think that I would have learned the things that I learned, right? I'd probably still be a believer in technical analysis. So I was kind of anti-Bitcoin from the beginning, and then 2016 came along, and after the Mt. Gox crash, I was like, see, I told you, and I thought it was dead for good. I really did. I thought, well, you know, it'll probably have other waves in the future, especially as the halvenings happen and everything. But this is going to really destroy trust in cryptocurrency. And then the 2016 rush happened, right? I'm kind of in the same. I kind of feel the same way though now after FTX, as I feel like this really hurts. Like, maybe Bitcoin can get to new all-time highs, but I don't think that Bitcoin's reputation ever recovers after FTX. I really don't. Anyways, 2015-16 was when I was like, okay, this is coming off again. I should make money off of it and contribute, even if I understand that the idea is dumb. So that's what I did. And then after that, and making money from it, and I predicting the crash to basically to the day, and not getting any recognition for it, I think really kind of soured me on the Bitcoin market, because I really felt like I really feel like that the only way to have success in the Bitcoin ecosystem is to cheat or lie. That's how I feel. I feel like that if you come in and you teach people about how the market works, that they don't want to hear that, especially not in Bitcoin, because it kind of suggests that Bitcoin is a bad idea. So they don't want to listen to you. You don't get popular. And so I see all of these other indicators. Okay, so I have an indicator that is basically like the Buffett indicator for cryptocurrencies. Gets largely ignored. And meanwhile, the rainbow oscillator is like the thing that all of the cryptocurrency creators are looking at. It's so retarded. Especially that one, because it's like, okay, so all you did was take the lowest low ever and the highest high and then interpolate between that. And show that, yeah, it works for all the past data, but it does absolutely nothing for the future. In so much that basically when the rainbow oscillator broke through their supposed resistance, they're just like, oh, okay, we need to add more colors. So that's what they did. But that's what the cryptocurrency market is talking about right now. Am I better? Yes, I'm bitter about see, like that's the thing. I'm not bitter about leaving Goldman Sachs. They did the right thing, and it all turned out for me. But am I bitter about how the cryptocurrency market has gone? Absolutely, I'm bitter about it. I mean, I made money from trading it. I don't feel like it was worth it. I'm surprised that you don't use TradingView. The real-time data is cheap, no level 2, but all the futures market for $90 a month real time. For $90? No. When I worked for Goldman, the only way that I could get live data was through TradingView, and so I paid for the $10 subscription, whatever it was. And I would get live futures data. Now it's $90 because I don't pay $90. I pay like $30 plus platform fee plus live trading license for Jigsaw. But just the data portion is $30 to $50, depending on what Rhythmic is doing. Well, a little bit better of a pullback here. I wouldn't, we are seeing some pushback in volume in the 30-year, not so much in the others. I'm seeing oil under pressure here a little bit. I'm seeing that the dollar has kind of found a spot somewhere around 106.6 here. I'm not sure. You want the lo-fi? Sure. I'll do the lo-fi. We can do the lo-fi. I really like the hype. I mean, honestly, I think most of the time we're going to do hype. But we can do lo-fi if we want things to be a little bit more chill. I do think that today, I'm looking at it. Well, oh, all world exchanges. Yeah, that would. Oh, I see what you're saying. You're bringing that up because I don't get Eurex data. Gotcha. Nah, but you know what? Like, there are some really great things about TradingView, but there's a couple of things about TradingView that kind of make it that I don't think I could ever see myself trying to live trade with it. You notice that when I want to go and look at like really far back, NinjaTrader isn't really appropriate for that, right? NinjaTrader is really optimized and well should be. And when you're looking at a futures platform or if some new great charting platform comes out, you're looking at it, one of the things I would look at is what is your ability to limit the amount of data that you're taking in, right? So, NinjaTrader charts, by default, there's a limit to the number of days that you pull in. And if you go to the end of that, it doesn't automatically pull more. But TradingView does. That's good. Okay. But like, there's some things about the programming. There's some things, well, largely the thing that bothers me about the programming is that their backtester is just like total bullshit. Their backtester makes everything seem like it works. So I don't think I would recommend live trading with TradingView, even though it's probably the cheapest. Like if you just want the US market, it's just like 10-20 bucks a month or something, if not free. Well, I am wondering if the treasuries are not gonna retrace this. Because here's the thing. So here's the thing that makes me think that the treasuries might want to retrace this. Is we had a really strong downturn here, but the spreads did not move very much, and the spreads are now steepening quite aggressively. The watch list sucks. The biggest downside to Jigsaw Day Trader right now is that it doesn't have a watch list. I think that if they add the features that I would anticipate Jigsaw would add if they added a watch list would be awesome. It would be awesome. They really should get. I really wish they get on that, but I think that their development is focused on some other things, and it's been slow going, to be honest with you. Thin book today. It is thinner than it was yesterday, isn't it? The micros are still trading the. So let's pull up the new month in the micros just to catch what's going on over there, or just to take a quick little peek here. So let's see here. We want Z. Yeah. So on the new month, I don't know why my like rollover dates in NinjaTrader are like way off, because they're not. I don't think that they're gonna actually switch over until Thursday. Could be wrong, but I've found that they trade right up until the very end. So I don't think that they'll switch until the 1st. Now, if we come back and look at the back month in the Treasury, so the December contract in the Treasury, you can see that the back month in the Treasury is now completely gone. So it looks to me like yesterday we had slightly better liquidity, probably because of people doing the rollover, people in the 10-year rolling over yesterday. And I guess, I thought because of, there was movement yesterday too. But much stronger liquidity yesterday. And I thought, okay, maybe the March contract is going to be better. And now coming in here today and seeing that it's the worst it's been. Well, not the worst it's been, but as bad as it's been this whole year is a little disheartening to me. But you know what? We had a strong move too. So that might be, because look, once you get higher up here, it's back to okay prices once you get higher up. And it's decently thick on new lows as well. So I think that the Treasury is kind of a little bit, a little lighter because we had this kind of bizarre move. One of the things I'm wondering at the moment on the move in Treasuries is like, am I the only one that doesn't know what's going on? Because we found that the volatility will persist longer if the market is unsure of what caused the move, or if it was created, purely, what is the word, exogenously, like purely created by the market. So maybe that's the case. Okay, DC Ferrex got a hardware question here. Thanks for the stream. Any recommendations for building a PC for trading a fast PC with no lag GPU, CPU recommendations? Well, so for the GPU, all you need is a separate video card. So just about any video card would work. So the low end right now, what I would be looking for is like a 1600 series NVIDIA card. So like a 1650 is the cheaper one, or a 1660 is kind of the more average performance one. So you can play decent game, like you can play Overwatch with the 1660, for instance, right? But you don't really need that amount of graphics power unless you're going to be doing machine learning, right? If you're going to be doing machine learning, then maybe it's worth getting like the $1,000 video cards or whatever the deal is, right? 1660 Ti is, yeah. I was thinking about grabbing a 1660 Ti through the sales here, because I have a 1060, and the difference between the 1060 and the 1660 is that the 1660 has the newer infrastructure, and it has like the separate encoder, and having a separate encoder would help me. But would help the stream a little bit. Okay. Now, for the CPU, you're kind of in a conundrum right now. We were talking about this the other day, my own conundrum, because I anticipate that I will upgrade my computer in 2023 or 2024. And the issue that you have right now is that we're running on a new generation of hardware, a really, really significant step up. So we have a new generation of DDR memory, and we have a new generation of PCI Express. And those technologies are so new that there is not really a lot of hardware that really takes advantage of it, and you're not really getting a huge performance boost out of it yet. I think that in the distant future, it will result in bigger performance increases. But right now, the change in this generation of Ryzen processors, like if you get a 7600, their new Ryzen 7600 versus their old Ryzen 5600, the change in performance is like 10 to 15%, right? And the jump up in cost is pretty significant. So Kyle says I'm boycotting the next gen. So that's why for me, I haven't tried getting anything during Christmas. Maybe I will nibble after Christmas sales, but we'll see. I'm also concerned, like one of the things is I'm also concerned. I think that the flows going into the end of the year look pretty positive. So that's no guarantee that we're going to rise, but I think that December looks okay. Where I get concerned is from January to March. I'm concerned that we might see some continued volatility January to March, followed by a little bit of sideways action, and equity markets not really truly recovering until March of 2023. So that is maybe when I'd be more interested in getting a new PC, or seeing what the next generation of hardware is after that, right? So the gist of that is that right now, if you want to get the best bang for your buck, it's probably better to go for the old hardware. So get a Ryzen 5600, 64 bits of RAM if you can. You need at least 16, but I think that in trading you could maybe actually make use of 64, especially if you're going to do any kind of back testing sort of stuff in NinjaTrader, right? And yeah, that's about as complicated as it gets. RTX 3090. That looks good. Yeah, that's another thing is I've wondered, should I get an RTX 3060? I don't really play the games enough to justify getting a 3090 nowadays, but I would like an RTX card to play RTX Minecraft. I really want to play my RTX Minecraft. But so that's kind of where you're at. Do you do that, or do you go for the new generation of hardware and hope that the motherboards last for a few years and you can upgrade later? That's kind of your conundrum. So there's kind of, at current time, there's kind of some big advantages and big disadvantages to upgrading. A year or two from now might be a really, really good time to upgrade. So we'll see. They're moving again, and this time the yields moved. This time the yields moved on that. And the 30 year just like sold, like just cratered there. Okay, so Alligator does say that the treasuries are falling more. Main data in Euro was German CPI slightly lower than expected. Bottom of the hour, same for Spain. Bad news, core CPI stable. Overall, in my opinion, curve should both steepen swing scale. No problem, DC. Verax. I mean, I feel like I should be participating in this trend, but I just don't know what's going on. Can you tell how much it eats away at me when I feel like I'm not the one in the know? But I guess that's the way that you should be, because being in the know is kind of a lot of where our edge comes from. There's another new low. We're going to get another basis point out of this, it looks like. Oh, hip hop beat and piano. I feel like this track is kind of a little more jazz. Yeah. It's like lo-fi jazz. Do you follow footprint charts? So I don't actively have a footprint chart up. If I'm, want to look back at a specific location and try and understand what happened in the past, I think that a footprint chart can be really, really useful. I think you got to remember that everything that we're looking at from a technical analysis basis is basically looking at past data, right? So there's a limit to how much information we can actually glean out of that, right? So the only reason why I'm saying this is because I think that the footprint chart can be a really useful tool, but there are a lot of people out there that teach that like footprint chart is the tool, that you just get the footprint chart and trade from that and you can be good. And it doesn't work that way. It doesn't work that way. First of all, it's not as good of a tool as just watching the data live on the DOM. Okay, there's more information that you can get from watching the DOM, right? But then number two, even then, there's only so much informational content you can actually pull out of it, and it's not very good at predicting the future. So yeah. If you like footprint charts, I would totally learn about them. Just be really careful about the people that are teaching you, like, okay, you look for this particular setup on your footprint chart where there was unfinished auction on the high, and then it's likely to go back up, all that sort of thing. It's nonsense. Back tested those, they don't work. Use market profile TPO with footprint and price ladder. Yeah, I think that market profile gets abused even more. I think that a lot of the popular ideas around market profile are really yeah. I mean, there's a reason that distributions happen the way that they are, but I think that the auction theory folks kind of have a couple of things wrong that really hurt them. Maybe it pushes size. Well, it looks like that they're probably going to get 113 even, right? This little extension lower is tough to watch. I mean, I could have taken this at any time. I literally could have come in when we opened up and just gone long micros and probably be up at least $20-$30 right now. Right? But I just can't figure out why it's selling like this. It looks like the dollar's moving again. It seems like there is a global move. Money is shuffling around for some reason, and I'm not sure I understand why. Perhaps the move that we're getting is an extension of the selling that we had yesterday when we had a lot of hawkish Fed speak. Because when you listen to, it's not Bostic. I forget his name now. But, there's one guy that he's said that they're going to have to continue increasing interest rates all the way through 2023, which is very, very, very different from what the Treasury market is anticipating right now. So this could be follow on from that. At this point, I'm kind of thinking that this, well, not kind of thinking. I'm concerned that now is a trend day. Like, I feel like if I come in and I say, okay, it's just going to keep going, I can get 3.74 to 3.75 at least. I feel like that if I take that trade, that's exactly where it's going to reverse. But it's starting to act like it could just be a trend day. How big of a change has this been? Okay, it's only been about a 10,000K change since that first initial downside. We haven't seen that significant of a change in cumulative delta into treasuries. Oh, it's evening for you. Okay, your view on delta Okay, I have an opinion on delta divergence. Okay, that I think is I don't want to say like a significant opinion. I'm gonna teach you something that other influencers in the space I think don't understand, that I think is really, really useful to the beginning trader. Okay, so when what you're talking about when you say delta divergence is typically if I see price move up, I'll see cumulative delta move up as well. But sometimes, and this is particularly true in a instrument where there's a lot more hedging flows and it's much more of a derivative, like the equity markets do this all the time. But there can be times where you will see the cumulative delta is actually net selling and price actually moves up. I mean, or one will go flat and one will be moving. Okay. So when you see that, the way that we can like mathematically describe that is cumulative delta and price tend to be heavily correlated. And delta divergence is a situation where cumulative delta and price are not correlated. So you could go and you could put a correlation indicator on top of the cumulative delta indicator with the price, and you could say how correlated they are. And then if you start to see a negative correlation between the two of them for a certain number of periods, then we have a confirmed delta divergence, right? That's how you would identify that situation. Okay. What you're getting from that is that cumulative delta is not being very predictive at the time. So I take the opposite view of what most people are going to tell you, because most people will tell you, okay, that delta divergence, that means that there's an opportunity. Well, what I've found is that usually there is an opportunity, but you don't know which way it's going to go. So unless you have some other larger piece of information about like what the market is going to do that day, there's no trade, because the market is basically telling you that the market orders are not in control of this thing. So if you're trading order flow, you don't have a very good setup there. So to me, delta divergence means stay out. When you're not seeing the correlations that you're supposed to see, that means that your strategy is not going to work very well. And I've back tested these sorts of things. You do better if you just avoid those situations. I back tested that one specifically. Now, backtesting order flow is a little bit sketchy, so I think you should take that one with a grain of salt. But this applies to any other kind of divergence, right? Any other kind of divergence that you come in here and you're trying to trade some sort of a correlation between assets, and when the assets seem to become uncorrelated, you know, a lot of people would say, okay, here's the time for the mean reversion trade. No, just walk away. Trust me. Thank you. I'm literally in heaven right now. Can ask anything without fees in it. Yeah, that's what I'm here for. I would like to charge for things, but not for developing traders. I think that the whole thing is that like we're on the live stream and people can come in and ask questions, and I don't even think of it as like, I mean, of course I mentor a lot of people, but to me it's more like a collaboration, right? Because the reality of the situation is that the odds are very much stacked against us, right? So we kind of have to work together to stand a chance, right? So I view this stream as more of a collaboration. Maybe it's not always that, but that's the goal, right? You're getting a little bit of a pullback here, but it still looks awfully heavy, man. There's about 5,000 contracts net selling there. USD JPY rises modestly as yields move to the upside. Let's pop over to Zero Hedge and see if they have any kind of story about the moves that we're seeing. Markets cheer Chinese vaccine drive announcement clearing path towards reopening. That could be part of the move. Did European inflation just peak? Yeah, I use financial juice as well. So the issue that I'm dealing with this morning, Code Lounge, is that here this morning, when we came in at about 8:15 Eastern time, 8:10 Eastern time, we saw quite a skip to the downside, and I don't have any confirmed headline for why that is. Perhaps that was the moment that, well, so that story that Zero Hedge posted was at 550. But maybe it's doing that based off of China anticipating that China will reopen. I don't know. That seems to me that this, well, okay, let's read this story, okay? Hong Kong markets and Chinese stocks listed in the US surged in pre-market trading as Chinese government health experts made an unscheduled overnight announcement in which they not only vowed to speed up COVID shots for the elderly, but to avoid excessive restrictions. Okay, so they did say they're also easing restrictions. Fueling a new round of bets that Beijing is bending to pressure of an economic opening. Okay, so can we come up with a theory for why that would move treasuries down? I'm not sure I can. I feel like that China reopening should make the yuan stronger relative to the dollar and should make the dollar weaker overall. And we're seeing the dollar strengthen. Is inflation just peaked in Europe? Does that mean, well, that would mean that interest rates in Europe would decline, not rise. And here we're seeing interest rates rise across the board. We're now at 3.75, so we've moved 5 basis points on the session overall. So I'm just not like, unfortunately, I am not in the know on this particular setup. Something's happening for sure, though. There was an opportunity there that we missed. Well, so let's see here. There's the users overwhelming to try and decipher them. Same thing with NR7 alerts, narrow range. Well, so when you're seeing a narrow range, that to me is a sign that nothing's happening, right? So when you see the reason why people think that you know, the market kind of narrows and then you get a volatility surprise to one direction or the other is because the way that large meta orders execute are basically like create a liquidity hole and then trickle as much volume as you can into that liquidity hole until the liquidity hole is no good anymore, and then you push it again. That's why you get that kind of movement. So if you try and trade that in the treasuries, what ends up happening to you is you just get faked out all the time, because there are days where the treasuries just don't do anything, because they really don't move if there's not a good reason to do it. Code Lounge, more number of retail traders and investors are good or bad? It's good, but it kind of depends on what you're doing. So here's the thing. We've learned that markets are not informationally efficient, which is to mean that the current market prices are not actually truly reflective of all currently available information. There can be orders that need to be executed because a fund needs to be rebalanced or whatever the deal is that will move price very, very far away from where fundamental value is. And there's absolutely no informational content behind it, right? Because it's just random. It's just rebalancing and stuff, right? So what that means is that the amount of, opportunity that is available out there to trade off of an informational inefficiency in the market are abundant. They're just absolutely everywhere. Okay. So that means the market is competitive. Okay. And there is on any one particular edge, there's only so much edge that can be pulled out of it. Right. But the market is so large and diverse and inefficient that there is just more opportunity than we will ever be able to actually take advantage of. In fact, that's kind of the problem, is that, there might be an edge there, but can you actually like catch it? And, because there might be the opportunity, but it just doesn't move that time, and it doesn't move until you're like bored of it, and that sort of a thing. What time will be the next is a good question. Well, usually we say 45 minutes from the last down move, right? The last down move ended at 7:23. Are they kind of following things here though? That's 6:12, 6:20, so that was 15 minutes. 6:45, and then this one didn't start for another 30 minutes after that. This meta order seems to be executing on a faster schedule, so we might get another move in 20 minutes. The thing is, we have, I don't know if that would be a good timing one though, because we do have fairly significant news coming in consumer confidence at the top of the hour, right? So anyways, more competitors in the market competing with us is overall a bad thing, but there's enough opportunity available to us that it's kind of a trivial matter. And the whole thing is that the odds are really stacked against you, because the amount of information that we have access to, I'd absolutely, I think Codeland, you said you use Financial Juice, right? I use Financial Juice as well. I have an affiliate link in the video description. And I really would not recommend trading without a news squawk, or at least without having TweetDeck open and following Twitter. Okay, so informational inefficiency is like a very available, or sorry, what was the point? The point is there are informational inefficiencies available, and there are some ways to get some information, right? And yeah, you are competing against other people for those informational efficiencies, but the current market setup is that we're so small relative to those big meta orders that, are trading like the end of the month flows. Okay, that the market is like even more inefficient than it should be. And basically, as index funds have taken over, the markets have become less efficient, essentially, right? So it would be a very positive thing for the markets overall if we had more informed speculators in the market. It would mean that we would have a more efficient market. Okay. But that's point number one. And the other point that I was kind of hinting at is that at least in the current situation, we benefit more from the collaboration and information sharing with other retail traders. We benefit from that more than we are hurt from the competition from other retail traders, because the informational inefficiencies are so abundant, right? So that's why it is to our advantage to build a community and collaborate. right? Always have the squawks open on TweetDeck Fest. Yeah. Well, I mean, the having the audio news squawk is faster than what you get on Twitter, but Twitter is a pretty good way to keep track of, I really like Twitter for following, significant. So for instance, Nick Tamiros tweeted 3 minutes ago, home prices declines accelerated September. All 20 cities in the Case-Shiller Index posted monthly seasonally adjusted declines in prices. U.S. home prices fell 0.8% last month and were down 2% in the third quarter, down 8% annualized. You want to know when Nick Tamiros tweets. You can only get that through TweetDeck, so you can absolutely, actually, if anybody can brag on this channel, it's you. Come on. Well, actually, there's a number of you that I'm totally fine with bragging. Did you catch a big trade or something? What'd you do? What did you do, actually? This pullback here is looks. Am I wrong here? Maybe it isn't. It feels to me like this pullback has been wider than the previous pullback, but I guess that's not actually true. Wait, what? Yesterday I was the 100% volume on the listed bub spread on the H20. What, really? You transacted the whole volume? All 4 of them. Good grief. Are you, is that to mean that you're the only person that actually used the exchange traded spread? which is actually quite funny. Yeah, Bub is Bub 2 and 30? I forget which is which. I have to pull up the page. Yeah, I'm sure there was spreading it out, right? So it seems to me that the really big, yeah, ZBUB. Oh, okay, ZBUB. Okay. Yeah, it seems to me that the really, really big boys executed it in the individual legs. Market Ear tweets SPX right on the 39.69 CTA level. It is so funny still. I'm surprised though that you're getting involved in those spreads. Do you still have the position on, or was it a short-term trade? You got smoked in oil? Oil is taking off here. So, like I said, I feel like brain. You saying that about oil just has me thinking now, like, if I come back to oil here, oh man, it's so volatile, oil. It's still on, just starting to build. Okay, cool. So wait, did you take it flat or did you take it steep? I would think flat, right? 'Cause flattened yesterday. Be wrong. So we were kind of eyeing oil because it was like, okay, is oil going to come down to Biden's $70 a barrel price that they want to refill the SPR at? The news today that basically suggests that China is backing off of its zero COVID policy due to widespread rioting and so forth. That's definitely going to drive oil higher, right? And that's why why we're higher overnight, and here this morning they're taking another leg up. And so I kind of look at $80 a barrel and I'm like, okay, well, maybe they're gonna go again. So like, is now the time for me to go and get into like Chevron or something like that. I'm kind of thinking about it. I don't feel like that now is a super great time for like a big fundamental trade though, because we've got a ton of other information yet to come. Uzi, did you post in the wrong channel? the first comment he's made in here, he's like, nah, that was like 3 years ago I did that. I would like to keep that to you. Okay. You can keep it to yourself. Oh, you asked if now is the time to get into Chevron. No, that was 3 years ago. Oh, yeah, sure. Well, so one of the things that I should note is that Chevron and the other oil companies are basically, Goldman Sachs posts this index of like most important shorts. Basically, all of the hedge funds have been shorting oil on an anticipation of a mean reversion sort of a play. And of course, because oil has been getting hammered, it has been working for them a bit, right? But if China's going to full on reopen, then you're going to see a lot more oil demand come back into the market. And then that just means that's just tinder for oil to go higher, right? Like if we get a situation where we get real momentum come back into oil, then those shorts are going to be so screwed, right? But well, I don't know. They were moving up. Oil is actually pulling back now at the moment. Oil is just way too volatile. I was thinking about this yesterday because some of the best trades that I've taken have been in oil. But tomorrow may well be a difficult day in Europe. Well, the big one tomorrow is we've got Powell, right? So let's not forget that. I really wish I knew more, going back to what we were talking about with Akshay, I wish I knew more about, you know, when is an advantageous situation to put a spread trade on. Because from what it seems to me, it looks to me like the reason the spread trade works so well, or why they say, you know, like people tend to say you have higher probability on spreads, is because most of the time the spread is flattening. So you can just come in, take a flattener. If it goes against you, just to hang on, it'll flatten back out. And the only time that this doesn't work is when that short period when the Federal Reserve reduces interest rates and the yield curve steepens. So that kind of doesn't help us in terms of like, okay, here's a good point to get into it and all that sort of stuff. You know, because it's basically, it just says, well, maybe the reason they like it is just because they don't have to do all that stuff. They can just put the flattener on and... But it seems to me like Akshay is playing something different, especially since the part that he's taking advantage of on the curve is so far out. So the Treasury is kind of doing a little bit of like I think it's trying to fake us out. I think that they're trying to imitate that a move is happening and that they're about to push lower and stuff, but this might be nothing. They might just settle here at 30. It's largely due most of the time bond 1 and bond 2 are identical securities with different volatilities. Okay, yeah. So I understand that duration basically means the amount that a bond, will change in price relative to a change in interest rates. And securities with a longer maturity date or a further out maturity date tend to have more duration. How do I translate that into a trade? Is it that we saw volatility lately, and so now are you okay? Yes, and everything in UB basket rolls into ZB basket without a gap. I see. You're making some sort of larger value play that UB or ZB is too high or too low relative to each other when you consider that everything in the UB basket is about to roll into the ZB basket. But are you suggesting that you can kind of trade the spread in a way similar to volatility? That it's like, if we just had some volatility, you're going to see the curve steepen. And so going flat would be the same as shorting the VIX. Well, treasuries are still kind of looking to me like they're not done. Interestingly enough, despite very, very strong selling in the treasury market this morning, equity markets are largely unchanged. Haven't moved too much. 10 points maybe. Oil had that face ripping rally up $1, and now it's already coming all the way back. You know, so I'm thinking about this on oil because this reminds me of that situation we were in earlier last year, I think it was. Anyways, we had that situation where we were pretty confident that oil was going to rise in the near future, and it didn't work out. And kind of what ended up happening was there was an OPEC meeting that I was not aware of, because I have no clue what's going on in oil. And then after that meeting, then it was nothing but up. So if I had just kind of sat on my hands and waited a little bit longer, that would have been like an absolutely career-changing move. So I'm looking at this now and I'm thinking, okay, so it seems to me like, yeah, maybe oil demand is going to increase. We had a big move up and it's retracing here in oil. So who knows what's going on over there. But then I'm thinking about it, I'm like, oh, but there is an OPEC meeting soon, isn't there? And I keep seeing rumors like, so yesterday there was the rumor that in OPEC they were talking about production cuts again. And I'm like, didn't we already fall for that one? So I'm not quite sure what's going on over there. Okay, so let's see. Actually, I said a couple more. Yes, ZB in essence is 15.17 year bond, and UB is a 25.17 bond with an identical coupon, which translates to a duration of 13.6 and 13.75. Okay, so you're saying that in volatility, the UB moves about 1.4 times more than ZB, given a change in interest rates. So if you were anticipating a change in interest rates, you would basically, if you think that interest rates are either going to collapse from here or are going to shift back up to 4% on the 10-year, 1.25 times, not 1.4. I was just eyeballing it. I didn't do the math. You're right. 13, half of 13 would be roughly 6, so that would be 19. Okay. Anyways, that's why I said 1.4, 1.3. Anyways, so then I'm still unsure whether you want to go flat or not, though. I suppose if you think that interest rates are going to go higher, that you want to go flat, right? I think that if you think interest rates are going to go higher, then you want to go flat. Well, they are that close. Why does it have to be a bet on the curve? A bet on the volatility to hold. Because it is gonna, because if you're long or short that spread, well, actually, here's what we need to do. We still got 10 minutes. Okay. I'm worried that the Treasury is about to move something fierce here, and I'm gonna miss it. But that's probably just me being like crazy. You know, that's probably my own securities coming out. Okay. So we're going to do a spread, and we're going to do leg 0 ZB and leg 1 UB. And the ratio is going to be 1-to-1. And we're going to do candles. Okay. Surely he's flat. I mean, I don't think that he would be bragging about it if he wasn't flat. So I would take it then that would be, oh, you're bragging about it. Felt like I made it. Oh, they, yeah, 4-4 contract. You know what? Actually, that's the way that I felt the first day of like the 10-year Treasury, but that faded real quick. So. I tell you what, I didn't expect to see that spread have moved as much, but look at how much it moved today. Like if you took that trade, you're making almost 3 points. Is that for real? Yeah, you're selling the 30 and you're buying the Ultra 30, right? I do have it 1-to-1, right? No, wait, where's that 2 coming from? Oh, 2 is the number of legs. Is that right? Was it really 3 points? Of course, you could lose just as much. That spread is way hyper volatile relative to some of the other spreads, at least. Back to that jazzy lo-fi, huh? 5 minutes to go until the consumer confidence number. Let's just pop in here real quick. CB consumer confidence estimated reading 99.9, previous reading 102.5. From yesterday, it has moved like 8 ticks. Okay, I must have graphed it wrong. Must have graphed it wrong because it was saying that it was, well, or maybe the adjustments that I have to make on it are different because I was doing 1-to-1. Ugh. Looking at this story from Bloomberg that I was like, oh, I want to read that. Because there was like big tech has failed to live up to its promise. And basically what they're saying is that productivity is not increasing as much as they thought. I'm betting the reason is that companies are underestimating the amount of technical debt that they're taking on with these technology projects that they've added in here. And so really all you're doing is you're just shifting the jobs over to something that's more, more expensive to do. And that's why they're not getting the productivity increase. Of course, once some of these pipelines and certain issues, especially the big one right now is data analytics pipelines. Once the industry has figured those things out and best practices, maybe productivity will start to increase again. You probably didn't roll the correct contract. Yeah, well, it is probably doing it on. Yeah, that might be right. I think that I have my data. Let's see here. Merge back adjusted. So maybe it is because of that. We'll have to look at it in a week. Okay, back to 113 even. 113 even would be a good spot to see some volume start to come through. Super frustrated that had a big move and I completely uninformed on why we're going and did not feel confident in trying to participate in it. We could have taken at least the 20 and made $30, but I have no clue why this sell has come through. And it seems like at a really odd time. I do perhaps suspect, though, that somebody is this might be more of just a larger overall play on that the economy is still relatively strong and that they'll have to raise interest rates more than the market expects. I guess that situation kind of has me a little scared because, that's the one that could really hurt the market, right? I think we're just around the corner for Stable Diffusion /AI to revolutionize computer programming. I don't think so. I think that what artificial intelligence is capable of is being really exaggerated by its proponents and misunderstood by the larger public. So because I can come in and I can make something that looks like a real picture and can fool, can win an art competition, people think that we're going to be able to apply that kind of machine learning to everything, including computer programming itself. And I think that's highly unlikely. Yeah, it's just so for instance, they have this tool that you come in and you type you make a comment that's like, okay, here's a method to do X. And then it will try and write the method for you, and then you can maybe adjust it from there, right? That's useful, but you still have to modify it and adjust it to your code and stuff. It's just not. It's just, yeah. I mean, and if anything, then that just means that the software developers just move up to another even more difficult level. Okay, so here's the news. We did get some polling. I'm not hearing my news squawk. What's wrong here? Oh my gosh, I think I got disconnected. Okay, so we got a higher than anticipated consumer confidence, 100.2 versus 99.9. What? The treasury market's not really responding to that at all. That's really weird. No. What I think the next step of technology is going to be, and I know this sounds like super boring and not as interesting as what everybody else thinks, but I think that the development pipelines will become much more standardized, particularly at scale. So where it works right now is like we had a period where everybody was doing waterfall development, which was a really difficult way to kind of like plan projects out. And everybody in the industry moved to agile. Now there's a lot of like controversy around agile development because in many places it means that they babysit you and push you really hard to finish sprints and stuff like that. And so they don't like it. They think it's toxic in that manner. I think it really depends on how you implement it as to whether or not that happens. I don't think that that's anything inherent in agile programming itself. But what agile programming did do was it really pushed everybody into having a standard development pipeline. And the development pipeline that has essentially emerged now after 10 years is you make a ticket in Jira that tells you what you're supposed to do, and then you commit changes to your repository, either through a fork or through another branch in your repository in Git. And then you submit a merge request and you do a code review on the merge request. Okay, that's basically the pipeline, the software development pipeline that like the majority of the industry uses. And I don't think that enough people that are out there talking on social media and stuff like this are old enough now to remember this world before like Jira. Okay, but like I can't tell you how big of a difference Jira made to how people plan things. Okay, like we forget stuff a lot less, and you can just go down through your tickets and you can just do them. Okay, so that was kind of like the pipeline. Okay, now what has happened is there were other parts of software development that were not pipelinetized. Let's call it. Okay, so like one area is in monitoring. Setting up a monitor for all of your different processes, and what is the monitors that you need to have, and how do you track changes in your monitors and ensure that like nobody turns a monitor off maliciously or things like that. How do you do that? Right? Well, I would think that it would be the same sort of a thing. You'd set it up in a pipeline, right? So this kind of moved into this world of infrastructure as code is the buzzword. Infrastructure as code. So it basically turns into nobody should ever be getting onto a machine and making a local change to that machine. Everything about the machine should be contained within like a Docker container and a Terraform pipeline to set up the actual resources in the cloud infrastructure. Okay, and yada yada yada. So what we're seeing right now in the tech industry is most companies are moving from maintaining their own infrastructure to using Azure, Amazon AWS, Google Cloud, etc., 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 to handle their infrastructure, right? And it's not completely standardized, but I think that some things are kind of starting to take over. I really like Terraform for doing this sort of stuff. Monitoring is not standardized, and it's kind of a funny thing because there's like setting up the assets, there's like installing applications on the machine. That's another thing that you have to do that you might need a separate system to handle, that you might not be able to do with just a Docker image, right? there's like logging, there's process monitoring. Okay, so there's like 4 or 5 different components that end up making up like your DevOps infrastructure, and they're not unified. And generally speaking, they have to interact with each other on some degree or another. And so what everybody's doing right now is okay, so I use Sumo Logic and I use Terraform and I use Zabbix for my monitoring, and how do I get these things to work together, right? At some point, I think that what's going to happen, and if I was going to start a tech company today, so if anybody wants to, give me $1 million or they want to work together on something like this, I got some ideas for you, okay? What I would be doing is I would be creating a tech stack that, is built for I would just focus on one of these. I would focus on like probably Azure for me, because that's the one that I'm most familiar with, right? But unifying all of those things so that it's all part of one unified infrastructure and one unified pipeline. Okay. So once you've done that, essentially what you've done is you've eliminated all of the pipeline process level roadblocks that make software engineers less efficient, right? So what's happening, the reason why you're not seeing a whole lot of productivity increase in the industry right now is because we're spending so much time on tech debt trying to move things over to the cloud and figure out, get a pipeline that works for machine learning. So something that happens very, very frequently. So now that's the spot that I know the best, right? Now moving on to machine learning, the area that I've been learning about, machine learning pipelines are incredibly difficult to maintain. So you have all of these different processes that might be like processing data and putting it into a form that your machine learning can actually like utilize it in. And like what happens if a piece of data comes in that like one of those processes can't handle, and how do you make it so that if you have like 50 of these different things, how do you run it all and make sure that they all run correctly and stuff? So there's now this software to like orchestrate this sort of a thing so that when this one is done, then it knows that it can run this one and all this sort of stuff, right? So these are the places that I think the problems that the tech world deals with the next 10 years. Once you get past that and those pipelines are more standardized, then you should be able to see like really significant leaps in productivity, right? But then the problem that I think you're going to run into after that is that a lot of the software development that you're going to do after that is going to turn into more difficult problems. Right? Like right now, everybody's focusing all of their energy on pipelines and stuff. And so they're like not doing super complicated code and digging into algorithms as much. And there's going to be time in the future where they're going to have to go back into the algorithms and they're not going to have the experience in it. So anyways, that's my thought on that. So with all of that said, what does that mean? Here's what I think that means for our investing, okay, and what I've been investing is that I don't want to be in consumer technology stuff. That's not where the growth is going to come from, right? The growth is going to come from people that are making tools to help these pipelines along, and the companies that are doing the cloud stuff, right? Machine learning cloud infrastructure as code, right? So I'm not as interested in, so for instance, I'd be more interested in being long Microsoft than I am being long Apple. Apple continues to be a beast and everything, but they're not really generating innovations and making better tech right now. It's just not happening. I feel like their products are just getting worse, frankly. And unless they start a cloud, right? Because Microsoft has a cloud and it's freaking awesome, right? That's where I would rather be. Watch a few of your videos, interesting stuff. I've written a ton of strategies in NinjaTrader and ThinkScript, and things are only successful in stretches. Eventually, they all get burned. I think it's mostly because the market is truly well, I wouldn't say it's truly random. The way that I would put it is that the past market data is not very predictive of the future market data. It's just that simple, right? Like the thing that predicts where the market is going to go next is what information is coming out. Now that part is random. You can't guess like what's the next headline that's going to come out. Like you can kind of guess, but like it's always going to surprise you, right? Once you have the informational content, and you combine that with other things that will move the markets that are not informationally based. Now you can make like reasonable predictions about where the market's going to go. Like, okay, the seasonal flows are positive, so we're likely to move up in the S&P 500 into the year end. It's no guarantee, but based on seasonality and the other things that we're seeing in the flows, probably we melt up a little bit this year, right? The end of the year, right? But you can't come in and say the market just moved up X. That means that it's going to continue moving up X. There's on a risk-adjusted basis, those trades just don't work. Surely you've seen, well, so the reason that happens, so you need to understand the simple model that we get in our heads when we say like, I want to trade informational inefficiency, let's just say, okay, is, okay, so if a piece of news happens and it's good for the economy, then I want to buy. And if it's bad for the economy, then I want to sell, right? And then you're going to come in and you're going to see something where it's like, oh, okay, the economy, this is really bad for the economy. And then the S&P 500 rallies because that means that the Federal Reserve is likely to lower interest rates, and bad news is good news, right? Why does that happen? How does that work? How do you sort that out? So the framework that you need to work from is not from an informational frame, from a fundamental perspective, right? So the fundamental perspective would be I come in and make my estimate of what the GDP is going to be, and then I use price earnings and all of that sort of thing to come up with the number for what the S&P 500 should be at the end of the year. And that sort of analysis only works on like a 3-year timeline. Okay. That's it takes 3 years for that informational efficiency to be recovered. Okay. So what you should be looking at instead is the orders. So you need to sit and you need to look at, given this piece of information, what does that say about what the next set of orders are likely to be? Okay. So I can come in and that allows me to come in and make a trade and say, okay, if this number is really bad, the market might rally really high because the market is so dependent on central banking support, right? You got to predict the orders. That also means that you'll be able to look at things like, what is the seasonality at this time? What do large institutions, how do their strategies work? And is there any kind of quarterly rebalancing that is likely to happen because of the way that the market had moved that quarter that we're likely to see at the end of the month? That, you can make those predictions. And when you take all of the predictors of order flow together and you combine them together to get an estimate about whether the flows that day are likely to be up or down. And if you don't have something that gives you a really strong probability of predicting what the future flow is going to be, then you don't have a trade. That's why the market has moved like really far here. I mean, it's like a 50. I missed out on $50 today, basically, right? And I didn't take it because I didn't know why they were moving, and therefore I have no reason to expect that there's going to be more orders. Actually, this move has been a little fishy because we're actually like higher on a cumulative delta basis for treasuries. We've moved we've seen quite a bit of delta buying. So you see what I mean? But so I got to be careful when we say we trade based on order flow, right? If I'm trying to predict the orders, then watching the orders as they come in is kind of important because one, that gives me an idea of like what sort of things tend to move the markets, right? But it also gives me an idea of like, if I'm right, what am I expecting to see? You know, if something is happening and I don't know about it, what are some signs that something's happening and I don't know about it, right? So watching and understanding the order flow is a really critical part, but you're very unlikely to make money just from trading the order flow with a technical analysis perspective unless you're a robot, because the edges that you can get out of purely order flow are really, really fast, and the robots have taken them, right? So that's why the way that I try to describe my trading style is we are informed traders. I reject this notion that the best trader should know absolutely nothing about what's going on and they should just look at a chart and make their decisions based on a chart. It's complete and utter nonsense, and nothing hurts retail traders more than that idea. You need to go and read all of the business news, keep up with the breaking market news, follow models about what market positioning is and what options positioning is, and predict order flows using that information. Hate this price action? Well, this is definitely what I'm like was worried about, right? Is like it comes down. I mean, maybe it just settles here, but what are the chances that maybe it came in at 113 even and decided to try and go short again, right? We've been seeing flows come in and buy these back up, and we're seeing it again today. So I don't know if it really continues, but that's enough to make me really nervous about trying to take a position in all of this. I agree. I've been toying with automated chart-based strategies for 7 years. Wow. Well, I mean, I've been doing this in futures. I mean, I've been like following the markets and trading for a much longer than that, since 2008, but just futures trading for 5 or 6 years now. And you know, there were times where I let people convince me to just focus on the chart and stuff, but didn't really, you know, I found some interesting things, but they're just not reliable strategies. You know, there's issues with informed trading too, because you might have information that's not factored into the markets. But the problem is if it's not factored into the markets, there might be like a good reason why they're not trading on that yet. So usually you need some sort of catalyst to come in and nudge the market in your direction, you know? It does happen, but it means that you have to be really patient. You have to be really patient, and you have to be really good at saying, no, this is not the move for me because I don't know what's going on. Some of these lo-fi songs are a little sleepy to me. I have hurled abuses at the Financial Times journalists who came in to ask for comments post an event from my desk, and they would still write whatever they want. Really? That's funny. Oh, I didn't realize O2 half was VWAP. So VWAP touch, cool. Well, I don't know if that if I really have anything that tells me where it moves from next, but I think I should keep watching this here for the next 40 minutes and see where we end up at the very least. By the way, S&P 500 super tight. That sucks. Maybe somebody was saying I hate this price action. You're probably trading equities, huh? Man, I got something back in there and it's just like on the edge. I can't get it out. My nose. Man, we've been sick. I like it. So you heard about the triple pandemic where people have been catching flu, COVID, and RSV all at the same time. And I'm pretty sure that we've had all three of them now. But this last time my son caught the flu, and it has been hell. He basically sleeps all day, man. That poor little 2-year-old basically sleeps all day. It's been hard to get him to eat, but we are getting him to eat. So like, I don't think he's gonna die, but I'm constantly looking at this like, okay, this is the kind of disease that kills children. Like, this is rough. And I'm hoping, you know, I thought that I was like, I only ever got just like a little bit of a runny nose. And I've been sitting here like, okay, well, it got better, so it's gone. And now today, I feel like it's worse. So I'm like, I hope I'm not catching flu. Was it because the market participants knew? So are you talking about CB consumer confidence? I don't know. I'm really not sure what caused the selling in the treasuries this morning. It could be second, you know, bleh, can't even talk because I'm just so perplexed by it. No, I suspect that it could be follow-on selling after the hawkishness from the Federal Reserve speakers yesterday. That could be it. There was also some headlines in Europe and so forth. It seems like there is some sort of global macro move happening this morning. We saw a really aggressive move in the dollar that has since retraced, right? So there's definitely something going on, but I do not understand what it is. I just don't seem to have enough information at this time to sort out what it is, which is unfortunate because that's the sort of a move that we would really love to trade, but we were just not in the know on that one. Do you think a retail trader can have long-term success beating? Well, no. Not as in posting better numbers every year, but having a higher CAGR after, say, a 10 or 15 year period. Okay, so generally, so if you're day trading, okay, if you're day trading, generally the objective is going to be to have returns that are not as high as the S&P 500, but have less volatility. With the or the opposite, have more volatility than the S&P 500. So I think that on a risk-adjusted basis, that the vast majority of retail traders do not make money. I think that there are a lot of retail traders out there that claim that they are profitable, and when you look at it from a risk-adjusted perspective, their risk-adjusted returns are absolutely terrible. And, you know, listen, if you made money, you made money. But when your risk-adjusted returns are really bad, what that suggests is that eventually what you're doing is going to catch up to you and screw you over, right? So, yeah, I think that it's super hard. I think that, like, if you're so I gotta be careful here because I don't want to move into investment advice, right? I'm working on getting a Series 65, and I think that means that we're gonna start an investment advisor business. I don't actually know what I'm gonna do with it, but I think that it means that we start an investment advisor business. And so I got to be careful because I'm not making like a specific thing about you, but you have to come in and look at like what your goals are, what your certain life situation is, and you know, analyze all that sort of information to make a determination about whether or not a strategy is for you. Okay. And if your primary objective is capital appreciation, then futures trading is probably not for you, right? Futures trading is about taking on more risk than you normally would be able to. For retail traders, that's largely what it ends up being, right? And if you're not somebody that has that extra cash to spare to come in and waste on the long shot, then you really probably shouldn't be doing it, right? So I always get concerned when I see people come in and they're like, I'm going to switch my career to day trading. And it's like, okay, don't quit your day job, kid. Don't quit your day job, please. Well, what is the motivation to trade versus holding SPY? Just curious. Like another, yeah. So what are some reasons to trade? And I do have a video about this, about like, is futures trading for you? Okay. I think that the primary reason to get involved with futures trading is because you want to be involved in the market. You really enjoy the markets and you want to be as close to the front lines of what's going on in the market as you can possibly be. That's the primary reason to trade futures. Okay. If you have a really big wad of cash and you want to do something that is like hyper low risk, you can come in and you can do basis trading. Okay, that's another thing. That's probably the way that it should be done, but you have to have a pretty good chunk of change that you probably would want to put into something else. Okay, but you can do that as well. Okay. Or you really just want to take on a lot of risk. You really want to, you want to go in and try and make lottery tickets. Okay. Or, and then there's the spot that we're in. I mean, I think that the spot that we're in is kind of like, we really enjoy the markets and we just want to be on the front line. But then the other side of that is that you think that you're informed, right? If you think that you know more or are faster than the rest of the market, and it is possible to be that way, it's hard. It requires a lot of work, and you might need to pay for some news and analysis and things like that. But you can be that guy. You can. And then futures trading could be a profitable place for you. Now, the other issue here is it's ES, right? You have to realize that there is a lot of noise in ES in particular. When I talked to traders at the bank, they kind of laughed about trading ES. They basically felt like they couldn't make money from doing it, that it was just too random. So they said, it's crack for traders. Everybody loves doing it, but you probably don't actually have an edge. And the only stories that I've ever heard of where people really had a very clearly obvious edge was like, calculating what the index was supposed to be and trading towards the index back when it was on the floor before computers had taken over. So thank you, Edward Raleigh. I appreciate that so much. I just gotta hand it to you, very refreshing to see someone who knows something and doesn't BS like 99% of trading YouTube. Buy my course and make a conservative 1% now. Yeah, it's total nonsense, the targets that most people are coming out. Listen, I have a NinjaTrader indicator package. Okay, the things that are in my indicator package, it's not like some new technical analysis system or anything like that. Well, all I'm doing is I'm showing you information that I think that a lot of professionals look at, that for whatever reason the tools that we have didn't give us. Okay, like spreads and the dollar index in particular. Okay, that's what you get from my indicator package. That's why it's useful. It's more information that is useful to making decisions, but it's not a strategy. I don't sell a strategy. Well, I guess I am kind of promoting a strategy. My strategy is informed trading. And we're putting together a free PDF that I hope to have out in January. Okay. But I'm just, everything that I do is I try to have it based on empirical data and realistic, and I just don't think that I'm doing anybody's, they say these sorts of things like, if you have a product and you really think that your product is important, then you would do everything possible to help people get it, because even if you're like lying to people, if it's ultimately then beneficial for them, it's like worth lying. That's what a lot of people in marketing, the approach that they kind of take, right? But if what I'm really trying to do is to help more retail traders be successful, help myself become a better trader, and help us to understand the markets overall, it doesn't help us to push this nonsense or try and give people lofty expectations, right? And what's the thing that constantly frustrates me is that everybody expects me to be doing that, and then they don't understand, or they lose interest when they see that I'm not doing that. So when people come in and they see the difference, that to me is like the dead giveaway that, like, okay, this is somebody that, we want, these are the people that we're looking for to be part of our community and collaborate with us, because they get it. They've already been through it, and they're tired of the nonsense, and they just want to trade the best that they can, given that it's still very, very difficult. And we're going to use proven empirical information about how markets behave to try and use that, with the understanding that even with all of the advantages that we can get, that it's still super, super hard. You think that the treasuries retrace this whole thing? Well, we're getting to a point where my positioning model kind of says that we're like at the seller's average position. So I don't think that you can make a trade based off of that, but it does tell you a little bit something about the market positioning. Although maybe it kind of means that the opportunity here in the treasury is gone. Yeah, I've thought a long time about making YouTube videos debunking all these indicators and technical analysis with code proof, but I honestly believe people just want to be sold a dream. Yes. I think it's more than that, though. It seems to me that people on social media are overly obsessed with social proof. So it wouldn't matter what I'm saying to people. If I was doing it all in a super nice Italian suit and a Ferrari, then they would just eat up whatever it is that I said, right? What is the future for this channel? I don't know. We talked about that a little bit yesterday, didn't we? Right? Next video that I'm going to put out is Ninja Trader tips. So I have a pretty good list here of things that I think most people don't realize when they start out with Ninja Trader that I think help a lot. So I think that video should be a really good video for this channel. I'm hoping so. I hope that one should do really, really well. And I do have that PDF that I'm working on. I should maybe put out what I have, even though I'm not completely done. I was still working on kind of a little bit of information to try and help people get started with understanding macroeconomic trading, essentially. But the more important stuff about, that the market is not informationally efficient. It's very statistically efficient, though, and what that means about what is probably the better strategies for us to use as retail traders, and that part is written, and I think is really good. So we'll put that out in January. After that, I'm not entirely sure. I think that what I'm doing is I'm just kind of going around with whatever it is that interests me at the time, and wherever I feel prompted to kind of go, and I'm not always sure what where that ends or where that takes me. So I'm trying to get a Series 65 that would allow me to do investment advising. Apparently, I was looking. Apparently, there's something in Utah called a certified investment advisor too. Maybe I don't know. I don't know what that is all about. I tried finding more information about it, and I couldn't. But I don't know where that goes. I think that means that I start talking to people and start doing investment advising. I don't know how that helps the channel. I feel like it should help the channel, but I don't entirely know what goes on. I just, I'm just doing what I feel like I should. But in years past, I would come in at the beginning of the year and I would be like, oh, I totally know what it is that we want to do, right? Like this year, I think we smacked it out of the park. Of course, the channel hasn't like blown up or anything like that, but we have such a good library. I constantly find myself sitting here saying, like people have questions like, well, you watch this video, like we have the library is there now. Hold on, let me try blowing my nose. I don't know. Isn't working. You're by far the best on YouTube. Years ago, I backtested TA and realized it was garbage. You're the only person that goes after it besides Gary Norton. There are people who should know better but don't want to lose customers. Yeah. Start a hedge fund and trade it live. If I started a hedge fund, I don't think that I could trade it live, but I am interested in that stuff. So I guess the real answer to this question is I feel like that what has happened since the pandemic these last 2 years was we went through a new evolution. We didn't learn things that we didn't necessarily knew. I mean, we learned things that we kind of knew, but we didn't completely know, right? We didn't know from a mathematical proven standpoint, right? And so what we did was we spent a lot of time understanding that information, applying it in markets, and making videos from it. And our performance in 2022 has been much better as a result of that. Of course, the treasuries having a lot of volatility helps too, right? But we performed a lot better because of that. And now that we've done that and we've put the library and the information is out there, and I really think this is really important information. Like I really wish that more retail traders watch these videos, not only because it would help them as traders. And I know that some people think, well, that just means more competition, but just remember, there's so much informational inefficiency everywhere that there's plenty of room. Okay. And plus most retail traders are still going to fail because they don't want to put in that work. Okay. But not only that, but just having more people in society understand this stuff, I think is important, because we're making a lot of societal level decisions based on this idea that the market is perfectly efficient when it's not. And so it keeps giving us bad signals. So we need to do something about that. If more people understood the true nature of markets, it would be a benefit for Western society as a whole. So that's why I really, really want to see the YouTube channel continue to get more and more popular. And listen, I mean, we haven't grown as much as maybe we did like 2019, 2020, but it was still a really good year for us. And like I said, I feel like that was what we were doing this year, and I feel like we did a really good job. I think the videos that I put out this past year were great. Absolutely great videos. Okay. So that means that probably we're moving into a little bit more of a learning period again, I think. So we learned everything necessary to do investment advising. I think you're kind of on the right track, Zach, which is that probably from here, we have to start looking at a higher time frame strategy and maybe start trying to swing a CTA treasury fund, essentially. My theory is that when you're in an industry long enough, you just start finding holes that need filling, aka opportunities, ones that could only come from time in the game. I think that's true to some extent, yeah. People will naturally kind of come in and find their place, but I got to tell you, there are definitely people that have traded for years and years and years and years and don't make money from it, right? I got to prepare you if you're one of those people that wants to come and walk down that path. I have to prepare you that even with everything that we have, it's possible that you could trade for 5 years and still not be making money from it because it's just hard. But at least you stand a chance, right? At least you should be able to avoid like completely blowing your account every month, right? Or rather, I think that with what we teach on this channel, and with enough experience and effort and being informed, that you should at least be able to continue trading, right? That the amount of capital that you're burning will be less than the amount of excess capital that you have to continue putting into it to pay for data fees and so forth, so that you can keep trading and keep learning. I think that that's like really square one first. To even stand a chance, you got to be able to continue trading for years and years, right? So, but yeah, so I think after I pass this test, I am going to spend a little bit of more time reading some books on things like to try and improve my storytelling and leadership abilities. And then we're going to try diving more deeply into machine learning and institutional strategies with the mind that maybe someday we run our own strategy. Now, if we do that, I'm probably not going to trade those live. Maybe I'm trading those live, but off the screen, but we don't want you to be front running our executions. Matt says he doesn't like that. Well, I mean, look at the S&P 500, man. It's total shit for sure. Totally different. I have an idea. Real differentiation and real value addition. Trade and cover emerging market bonds. That's actually a really good idea. Actually, Akshay. Are you saying that I, as a retail trader, should trade emerging market bonds, or are you saying I should try and create a fund that trades emerging market bonds? Because I think the problem that I would have with trading, either way, sure. I think the issue I would have with trading emerging market bonds is getting all of the information necessary to do it, right? They are equally hard both ways, yeah. But it is probably the sort of thing that we could do with the resources, you know? Alice J is an example of what I said. You see her long enough, you start to see whole stuff. Oh, Akshay? Yeah. Well, he kind of had the advantage of being taught by an institution, right? And having a wad of cash to do it with. Yeah, so like here in the United States, if you really want to be involved, there's a lot of information to read about the economy and what the central bank is thinking and currency related news and stuff like that, right? The issue once you start trying to go to other countries is you don't speak the language, and it's harder to get those pieces of information, right? So that doesn't mean that we can't do it. It's just that would be a big, that'd be a big project. But I actually do kind of like that thinking. Yeah, I like one of the things, like one of my dreams has always been if I could trade Chinese bonds the same way that I trade treasury bonds. That would be, I think that maybe someday before I die, it'll happen. I really do. Treasuries are getting a little heavy again. Do you think that they're going to revisit the lows, or do you think that they're going to push back up? You know what, man? This indicator drives me freaking crazy. So this is not just like some nonsense technical analysis. This is basically what these lines are trying to do, is trying to say, if we make an assumption that a market maker, one single market maker, is absorbing every contract, that every limit order on a certain side of the market, and then at every opportunity that they have to take a profit, they take a profit, this is what their average position would be. That's basically what the indicator does. Okay, how you do that from an algorithmic perspective is a little complicated. Okay, it would be hard for other people to write this, but that's basically what the number is doing. And it is so eerie to me that how the treasury market in particular, I think the treasuries and equities seem to be the best with this. Oh, oops, I tried to open up my pen and I did the wrong thing. It'll come right to that line and bounce right off of it. And I tried making some order flow indicators and stuff to try and trade based off of those levels, and it was like a wash. And I think that there's probably some problems with like that kind of backtesting. And yet I continue to find over and over again that when if we're way down here at these lows and then we come up to that line, they bounce off that line. I feel like it does it almost every time. And then the other side of it is that if we're just kind of going along and then something really bad happens, they almost always go down to this line and stop. So that's the average seller position. This blue line down here is where buying market makers are underwater. So it's possible for a buying market maker to have made money on the uptrends and have just played his cards right, to make money. But once you get below that line, it basically means there's no way that the buying market maker could have made money. It does seem that it's really hard, especially for the treasury, to stay below that line for very long. But again, like when I tried automated backtesting of that, it didn't seem to work. So there's got to be something wrong with the way that I backtested it, because it just seems like it works so well. But I guess like that's still, you're still trying to do technical analysis, right? So when it bounces off of it, what does that tell you? That the shorts were probably covering and or were done to some point. So it could mean that the meta order is done and that there's not much opportunity left from here is what it probably means. How do you calculate the average seller position? You basically have to look at every order and say, okay, every filled bid is, so we're doing it from cells. No, it's not TA. I mean, it is based on it's a positioning model. Okay, so positioning model can be potentially useful. Coming in and trying to say, when my positioning model says that market makers are in X position, then I want to take a trade, doesn't tell you that. what it could tell you is it could tell you potential conditions. So it could say like, oh, hey, we're in a situation where no buying market maker is making money. And now all of a sudden we just got a piece of news that is going to like push them into the money. This market is going to move really, really aggressively because there's going to be a lot of people off sides, right? That's the sort of thing that you can do with it. Okay. Continue. So basically what I'm saying is every offer that gets filled, we're assuming is the short market maker taking on inventory. And every bid order that gets filled, we assume is that market maker taking profits. Okay. So I'm having to do that for literally every order, right? And matching up the exits and everything to make an estimation of what their average position would be and how much profit they could have potentially made during the day, to then estimate where they're like, because they generally tend to make money, but then comes down here and you can make an estimate of like where their break-even point is. So that's how it works. To do that, it's a really tricky for loop. Well, it's a couple of nested for loops, but it's really tricky. So I wouldn't expect the average person to be able to program it. That's why I turned it into an indicator, and it's part of the indicator package that you can download at speculatorsnet.com. But you gotta sit down and say, like, you know, that's a pretty complicated calculation, and then for it to bounce off of it so frequently there's definitely something to it. Did you know TA is the symbol for Company Travel Centers of America, and they own truck stops? How do you know they were executed? Well, I'm looking at actual trades, right? So basically you're making some assumptions, right? You're making some frankly crazy assumptions that aren't realistic to real life, right? But when you make those assumptions, it gives you like the best and worst case scenario, right? I'm looking at the actual orders that went through, and I'm just saying, okay, what if every single one of those limit orders that were filled were all the same guy? What would his average position be? Right? That's what I'm doing. And that's why you get a blue line and a red line, which average position for sellers, average position for buyers. And we were just about to get into that middle zone between the two of them, and it gets rejected. And that I see that happens a lot after a really strong down move day. I had, when I was working on my desk, a sliver go into my hand, and it took a long time to heal. And when I, push my finger over it, I can kind of feel, I don't know, I guess I'm feeling the scar, and it still kind of hurts a little bit, but so I'm constantly wondering, is there still a sliver in there, or is it just taking a long time? I don't know. Or is it just healing still? I don't know. Well, I suppose you're looking at market orders, right? I mean, there was a limit order on the other side that got filled, right? So yeah, we're basically saying for every filled limit order, okay, assume that they were all the same guy. What's his average position? How do you know? For every filled limit order. So so if I come in here and I detect a market buy, then what I'm going to say is That's, like we had 76 market buys into 04 half, right? So I'm going to say the limit seller just added 76 contracts at 04 half. They just added 8 contracts at 04. And I'm adding up all of those and getting an average position based on that, right? And then I come in and I say, okay, 340 sold into 03 half. And okay, so I'm going to assume there's only one market maker and he is short, and that when those 615 lots just traded there, that was him reducing his position by 614, right? So the assumption is that the market maker takes profits at the first opportunity that he has, right? So that's an assumption that is not realistic to real life, right? But what it does is it tells you the best and worst case scenario, essentially. That's why we do it that way. QJ Verdun, good morning. You're coming in right at the end of the stream, man. You could do average price for takers versus makers. I mean, it is essentially an average price for makers, right? When someone shorts an option, market maker is the buying side, he's long gamut, so he'll react to lower prices by buying. Yeah, you got to come in, man. We start the stream at 8:30 Eastern time. That's the time to come in, man. I only do it for 2 hours. The stream would probably be a lot more popular if I streamed in the afternoon. That's the funny thing. So that most people are just doing other stuff at this time. I've kind of discovered and had to decide. Yeah, you can with options. You can kind of make assumptions about that the market maker is almost always the limit order. Yeah. So I think that some people, there's another guy that kind of has a similar sort of a system, and he really thinks that that's what the market maker does, and so he's like, eventually it's going to come back to that line, and I think he really trades it that way. The problem with that, I think, is that you usually does come back to the line eventually, but you lose a lot of money in the meantime. All right, like the amount of risk that you have to take on to do it that way is insane. So you don't want to do that, right? But it gives you best and worst case scenarios, and I've definitely found that based on where we are in that range, and then if we get a piece of news, it affects how the market moves, because you basically get a really good idea of what the current market positioning is, right? The treasury market is net short today, and the average seller position over the whole session is 113.05 half. And what do you know? We come right up to that level, and then they can't seem to buy above that. Wonder why. But something happened. If somebody came out and said something super dovish, don't be surprised if we moved up to 113.11, which was the open. Okay. I am in the Mountain Time Zone. I remember hearing about that a while back. Yeah, I mean, I have a description of it in the documentation on speculators.com, right? What about Vanna or... Well, what I'm doing has nothing to do with options. I think that Kyle confused you. Kyle is saying you can do the same thing for options. Yeah, you could, and then you should be able to. I mean, I think that's what a lot of these spot gamma models are doing essentially, and then they kind of sort out, where the market's net vega, places where the vega changes significantly. It's basically what they're doing. But for us, Not that complicated. One thing that I really wish I could factor into my model is stop orders. So if I had the market by order data to be able to determine when an order was a stop order, then I could assume that every stop buy is a buy market maker puking their position and adjust the averages based on that. In the same way that I adjust for potential profit taking and seeing how that affects the model. That would be really super interesting, right? But it's just interesting because I don't pay as much attention to that model as I used to, because basically what happened was once I had that up there for a couple of months, I got to the point where I could pretty well guess where it was going to be, relatively speaking. So I don't look at it as much, but no, that the indicator that I'm talking about is on this chart over here. I'll make it big so you can see. So do you see there's a blue dotted line, an orange line, a blue line, and an orange dotted line. And that's the model. So the orange line, the orange solid line that they've bounced off once here already, is basically average selling market maker position. You don't trade equals it keeps nagging you in your brain. Yeah, that definitely did that to me today, man. I'm super hard. I'm a little bit bummed. I don't know. We could have tried fading the move. I will admit that when we were down in here after 113, I kind of thought, you know, this might be worth reversing, but that was such an excursion past 113. I suspect that if I had tried taking a trade, that I would have gotten washed out or scared out of the positions. So I didn't do it. I do use Jigsaw for my order book. So that indicator is written in NinjaTrader 8. So what I'm doing is I have rhythmic data, and then I route my rhythmic data to both Jigsaw Day Trader and demo version of NinjaTrader 8. I have a full NinjaTrader 8 license, but that license doesn't let me use rhythmic data, so I use the demo license. I have a video about that, CQG versus rhythmic data, but I digress. You know, when you scale down your trade and your break even goes, yeah, that's exactly what happens. That's why on this model, you will see these situations where this number goes up, for instance. It means that they took some profits and their average position moved accordingly. Because the contracts that they had taken down here are no longer being factored in. So like basically if we have a move, if you're the buying market maker, right? And we have a move down, then if we have any kind of a move up, you know, you're going to immediately be taking profits on the contracts that you caught down here. And so that's why your average position moves back up. Kind of interesting, isn't it? I gotta get going, guys. I lost track of time. I will see you tomorrow. In the meantime, stay excellent, team.